Hi guys, welcome to the next lesson. In today's lesson, we'll be going over on how to identify your trading range if you are unfamiliar with that. We will also be going over on how to differentiate and understand internal liquidity as well as external liquidity. And being able to understand both of those will help you be able to take advantage on both sides of the market, whether you are counter trend trading or actually trading with the trend. Now, right in front of us, I do have market structure drawn up. This would be real market structure in terms of how it would move within live market conditions. Now, I know when we hear bullish trend, we think of this model to the left. We're thinking of higher highs and higher lows and higher highs and higher lows as prices breaking bullish. But if price and live market conditions actually did move this way, it would be very easy for everyone to make money, correct? And unfortunately, the market doesn't move that way. It doesn't move very smooth. There is times where market will move very smoothly, but we will not get these type of market conditions all the time. And you have to also consider a lot of factors that come into play when it comes to live market conditions, and that is draws on liquidity all the time. The market has traps all the time. And so we as traders have to be able to react to those conditions and be able to identify those when we are looking for trades and to execute our positions. So realistically, this is what the market should be looking like. We have lots of push up before we go ahead and break structure and a lot of draws on liquidity. So I'm going to delete this here and we can just focus on this current structure that's right in front of us. So if you are intermediate and you do know a bit about SMC concepts, I know that you probably already have an idea and know exactly what a range is. For those that are not 100% sure on exactly what a trading range is, it is your high point to your low point. If you do use Fibonacci, you are required to draw your levels from the low to the high, and that's how you'll get your Fibonacci retracement. So it's almost the same thing. When we're looking for a trading range, we are looking from the bottom of that trading range to the high of that trading range, which is just your low to your high. Your previous low to where we broke structure, either bullish or bearish, whatever trending market that may be. So in this structure, we are bullish, correct? So we have a break of structure here. And we also have a break of structure up here. Okay. Now, what is our current trading range? Okay, so just looking at this structure, our current trading range would be from this low to this high, right? So our trading range is from this low to this high, because what had happened here was the reason why we have this low as our current trading range is because price had broken structure, making this our current trading range low. Now, to consider this our new high, or to consider a new high forming in a new trading range, what would need to happen would be price would need to break structure in the opposite direction. So because price came all the way down here, if we drop to like a lower time frame, let's pretend that we're on like the higher time frames. and we have lower time frame liquidity within this trading range structure. So for example, this is what internal liquidity would be. So if this is a higher time frame structure and we're bullish on the higher time frame, that must mean that there is all of these swing lows within this structure on the higher time frame, right? Because if we're on the 4-hour, we have multiple swing lows based on the other time frames, right? So this would be considered as our internal liquidity. Internal liquidity is simply just liquidity sitting within a trading range. And for example, this is a higher time frame trading range. So we have liquidity within that. And this structure is the same structure that it's going to be for the lower time frames as well. So this is not just to be used for the higher time frame. This also happens on the lower time frame as well. But this is just giving you an idea that no matter what time frame that you are in, this pattern or this model, this market structure is always at play. Remember, I was talking about in the beginning, the foundation is that the market is fractal, meaning that the same thing happens over and over on the same time frame. So this is what I'm talking about. This same thing will happen over and over on every time frame, no matter what time frame it is. So understanding that there is internal liquidity within your trading range is very important, because that signifies a reason for us to actually push down in the opposite direction. Do you ever wonder why we're in a bullish market and price always comes back for retracement? The reason why there is retracements in the market is because price needs to come back to collect orders. It needs to come back to a draw on liquidity before it can continue in the direction that it's going in. That's the only reason why price moves. The only reason why price moves is because of liquidity. The reason why it has pullbacks is only because of liquidity. So we need to understand that liquidity is a huge thing. It's the only thing that you should be paying attention to. So with that being said, we have internal liquidity within this trading range, meaning we have many swing lows in this trading range. Can you imagine how many swing lows this is? And what is swing lows? Liquidity. This is all liquidity within a higher time frame trading range. Now, like I said, in order to consider this a new high of our trading range, price would have had to break structure on a lower time frame. So it would have had to break this right here, which it did. It broke this swing low on a lower time frame. And then once it breaks the swing low in the opposite direction, only then can we consider this a new high for the trading range. Only then we can consider this our new trading range. Price has to break structure and break a swing low of internal liquidity in the opposite direction for us to consider this a new trading range. So then what happens once this happens right here after we took out the swing low? Then it'll be the same thing as the previous structure, right? It'll come down here, find a draw on liquidity somewhere, and then if we are in fact bullish, it's going to go ahead and do the same thing. We're going to have a break of structure, taking out the high, and then what happens here? We have a break of structure here. What then becomes our low? This becomes our new low. This becomes our new low. And we don't have a high yet. We don't have a high yet. We only have a high. Sorry. We only have a high only once price breaks a swing low in the opposite direction. Only then do we have a new high. Okay, so I hope that's clear. The only way we can have a new high is if we break a swing low in the opposite direction, and that will be our new trading range. Now that's internal liquidity. Now, there is also external liquidity. External liquidity is going to be the liquidity that is sitting outside of the trading range. Okay, so as this is coming down, as we broke this swing low to the left, price came down within our new trading range here. As this is coming down, price is also creating swing highs at the opposite end of this move. Okay, and then what's sitting at those swing highs? Liquidity right here, 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 and here. Okay, so as this is coming down, this then becomes our external liquidity. Okay, so this is our internal liquidity. We have our new trading range. Price had broken structure in the opposite direction. It's coming down to find a draw on liquidity before we continue back up bullish. And as it's doing this, before we tap into a point of interest, one thing you also have to remember is when you are taking a position, whether it's bullish or bearish, we are always going to target external liquidity. External liquidity will be our TPs. That's where we want to TP within our market. Okay, so after we're done taking draws on liquidity within this internal trading range, we go ahead and target external trading range. Okay, so say like price came down here, found an area, a POI, an area of interest, whatever you want to call it, supply demand, however you guys want to call that. It comes down here to tap into a POI and then to continue bullish, right? So as we're continuing bullish, it's going to target these external liquidity that was just created prior. So it's going to target everything that is outside of this trading range. That's how I want you guys to look at it. So we're always targeting internal liquidity, and then we're targeting external liquidity as well. So it just goes back and forth, internal to external, internal to external. That's how it's going to be. Okay. Another way that I also want you guys to see this is the reason why we're coming down. And like I said before, is only because of a draw on liquidity. That's the way that the market moves. The market comes down to grab liquidity, but essentially when it's coming down, we're in a bullish market, right? So a drop in a bullish market is just a hunt for sell stops. That's exactly what it is, and that's only what it is. A drop in a bullish market is a hunt for sell stops, okay? And under all these swing lows are orders. They are orders. You have all those people that place sell stops. Those traders, those sell stop traders, they have sell stops under each swing low, especially if this is a higher time frame. Like I said, we're going to pretend that we're on either the 1 hour or the 4 hour. This is a higher time frame market structure. Okay, so we have to understand that beneath every swing low, there are positions, there are stop losses there, and the bigger banks know this. The bigger players in the market know this. And so what do? They target the sell stops. Once they target the sell stops, they target the buy stops. Because like I said, we have external liquidity out here. After they target internal, they will target external. So what do they have here for external liquidity? They have buy stops. It always goes sell stops to buy stops, and then buy stops to sell stops. That's how the market works. It goes back and forth. And that is one thing that probably changed it all for me. Just remembering that and keeping that in mind is that the market moves to target sell stops to buy stops, and then buy stops to sell stops. It literally ping pongs on both ends of the market each time. So if you miss a position if you miss this position, because I would definitely take something like this as a scalp position. So if you miss this position, targeting sells, we can always target buys. That's the thing I love about scalping. It's that you don't need to wait on your hands for a position sometimes, although you need to, like I said, there is a level of patience when it comes to scalping, but you're not obligated to sit on your hands and wait for that perfect position. We can take advantage of the market on both ends of the market. You can find a decent risk to reward with a counter trend trade. As long as it's within your trading rules and your system, your risk management system, you are more than welcome to take that trade. And I encourage you to take that trade because the risk on that would be lowered depending on your stop loss and what time frame you're on. And like I said, this structure works for any time frame. It can be used on the 1 minute. It can be used on the 30, the daily, anything. But we're scalping. So I'm going to be using this on the lower time frames. But we'll get into the higher time frames and how we build a narrative off the higher time frames before we go ahead and drop down to lower time frames to find and execute trades. So, like I said, this is how we find our trading range. We want to make sure that we're breaking previous structure, and in order to find our high, we go ahead and we have to just be patient and wait until this breaks a swing low or a swing high in the opposite direction. This would be the same for bearish structure. Let me see if I think there's a way you can inverse this or something. Let's see. I literally have no idea, but there's a way that you can I know there's a way on here that you can inverse the chart to have it the other way. I don't know if I can find it. No. No. Right here. Ah, found it. Okay. Yeah. So then it would be the same thing as a bearish model here, where in order to consider it a new low, it would need to break a swing high in the opposite direction, right? So then this would be our trading range. Now, let's say something like this happens. Okay, so let's turn it back. Oops. Don't want that. Okay, so let's turn it back here. So say something like this were to happen. So, but I hate that. Okay. 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 So we have a new trading range here. Okay. So say something like this were to happen. Let me delete this. Okay. So if price came down like this, okay, wait, that's ugly as fuck. I need to start getting better at drawing shit on here. It be coming out so ugly. Okay. So say price is doing this, right? Okay. And say that we had something like this. Okay. So say we have price. So before price finds a POY area or before price breaks this high, say we had a break of structure, a strong break of structure right here in the opposite direction, right? We broke a swing high right here, right? This would not be considered a new trading range, okay? You would not consider this your trading range. This is wrong. Okay, this is wrong. You would not want this to be your trading range because why? Even though we broke structure here, this is still within this range. Nothing broke out of there. Okay, so even though you see, even on a lower time frame, and this is where people get really confused, right? Because if we are seeing this on the higher time frame, we know exactly where we are. But say we scaled down to a lower time frame and we saw this on a lower time frame, we're automatically going to assume, okay, market is shifting and now we're shifting bullish. But it's not bullish just yet. Okay, if this high failed, if this high here failed to create or failed to take out liquidity right here before breaking structure, it is weak. It's a weak low. Okay, so you need to understand that. If this high failed to take out internal liquidity before we broke structure in the opposite direction, it is a fail low. So this low will break. It is a weak low. Okay, and vice versa. If a weak low or if a low fails to create a new high, it is weak. Okay, so we have to understand that weak lows are very important within market structure. If a low or a high presents itself as weak, meaning that this low or high did fail to create a new higher high or a new lower low, then that previous low or high will be invalidated. Price will come back to it. It may react for a short period of time. Like I said, we may have a good reaction here. And if you are in the lower time frames, just don't get caught up. Okay, you can catch this move if you want, but like I said, it's going to be stemming from a higher time frame, so you don't want to get too caught up in that. You want to understand exactly where you are. You don't want to think that this is a market structure shift, because it's really not. You want to remember where you are in the higher time frames. Don't get lost in the lower time frames trying to catch everything, because the higher time frame is still key. Okay, precise entries always stem from higher time frames. Okay, so just understand that. But when we see something like this, like I said, in the market, if we have a failure swing, then this is going to be used as liquidity. Okay, because it is a failure swing. If we identify a low or as a low or high as a weak lower high, it can be used as liquidity. Okay, because then this will be used as liquidity here. And what price is going to do is, and this is exactly where the traps happen, and this is where you can kind of implement the models and pay attention to liquidity, the liquidity models. You can pay attention to what we went over with them when it comes to live market structure like this. This is where you're gonna kind of put both of them together and understand it that way. So whenever this happens, like I said, if a low fails to create a new high, or if a high fails to create a new low, then that low or high is then considered a weak low or a weak high, and they will get ran through. Okay, it's a failure swing. Failure swing low, failure swing high. Okay, and then that will be used as liquidity, because it's not true. It's not going to hold. The only way a low, what makes a strong high and a strong low is this needs to happen. Price needs to clear liquidity, like we did on the bottom here. We cleared out all the internal liquidity within this trading range and this structure previous, okay? Price would need to clear out liquidity and break structure. That's what makes a low or a high strong. We need to clear liquidity and break structure in the opposite direction. Okay, that's the two things that makes a lower point strong. Okay, but if it's like this, I mean, we did clear liquidity here and we did break structure, but it failed to break this high. Okay, so if price is just kind of hanging out here, like this, whatever comes back down, we're not going to consider this a range. Okay, this is not a range. And if you consider this a range here, you're just going to get confused. It's not a bullish range. Okay, when we're looking at this, actually, it can be a bearish range. Okay, we're still bearish, but on the higher time frame, we're bullish. And it's funny because this is another thing that you need to understand when it comes to price being fractal. And I think this may be, it can be difficult for those that are not used to trading the lower time frames yet, and something that you may need to get used to as a trader. And it might just take you some time and practice and really training your eyes to see this in the market, because I don't want you guys to get lost. Okay. So overall, we are in a higher time frame trading range. Okay. This move happened. This was a failure swing. It is not our new low just because we cleared liquidity and broke structure. It's not considered a new trading range yet because this low failed to create a new high. Okay. And when a low fails to create a new high, it is then used as liquidity. It's a weak low. It's going to get taken out. So although you can take reactions from that point on, just remember we're on the higher time frame and it is not a new trading range within the higher time frame. But you can take advantage of this on a smaller time frame. Okay. So we see these points right here. So we're in a bullish higher time frame trading range. Now, we can use this high and we can use this fake low, okay, or this weak low. We can use this weak low as a bearish trading range. So do you see now we are now in a bearish trading range on the lower time frame. So you see how price is fractal? It's crazy. It's crazy. It's like it's basically ranges, smaller time frame ranges within a higher time frame trading range. And that's how a lot of people can get lost. But remember now, higher time frame is key. So don't get lost. Okay, you can catch a position on this lower time frame bearish trading range because price did break structure. So if you were to drop on the 1 minute time frame, you could have caught this buy. But remember what we talked on the beginning as well. We talked about how within a trading range, what needs to happen? There is internal liquidity within the trading range. So what happened here? We pushed up to the upside. We broke structure in the opposite direction. This then was our higher time frame trading range. Price was coming down, collecting all this liquidity right here to the left, right? We had all this liquidity and price was taking out all the liquidity. Okay. But say like there was liquidity down here that was left untouched, right? And price had created a failure weak low right here. We broke up to the upside, but this low did not break this high. So what does that tell us? We're still within the higher time frame trading range, but we do have a lower time frame bearish trading range right here within a bullish one. So what happens here? Price creates this weak low, a fake reaction, breaks structure. You could have caught this buy here, but what is happening on the lower time frame as well? Price is fractal. So what's happening? The same exact thing that is happening on the higher time frame. What is price doing here when we break structure? It is collecting orders. And once price is done collecting all the orders, it's going to tap into a POI, an area of interest that you're looking at, and it's going to go ahead and break in the opposite direction. So what did we just do? We targeted internal liquidity. Now what are we targeting? External liquidity. Because we know that this low is weak, we're going to be targeting this external liquidity after. Price will then come down, take out this weak low, target and take a draw on liquidity on the rest of the liquidity that was left down here because this low was invalidated. Find a POI somewhere down here, tap into that POI, and then continue to fly. And this is exactly where we'll break structure here. And then when price comes back down, break structure in the opposite direction, that will be our new trading range. Okay. So I hope this made sense. I hope it's not super confusing. It is super confusing at first, but like I said, everything is fractal. Everything moves the same thing. You see how this pattern and this movement and market structure happened the same exact way as we're looking at on the higher time frame. It was just within a higher time frame trading range. So we need to understand that. Very, very, very important. And this is tricky when it comes to this. Like I said, because within a trading range, there's going to be a lot of movement. There's going to be and there could also be sideways movement because like we talked about in the beginning, they want to build up that liquidity. In all of the liquidity models, they want to build up that liquidity. They want to create fake reactions within a trading range. They want to create reactions where trendline traders will get in, Fibonacci traders will get in, and they're going to give these traders nice reactions. They're going to give them nice reactions because if they're not allowing these traders to win in their trades, they're not going to be willing to gamble or risk their money in the market. They're not going to be willing to do that. If someone lost in the market all the time, there would be no reason for them to put their money in there. And they know that. So they're going to give them reactions. So they have some winning trades here and there for them to just keep putting money in the market because that creates the liquidity in the market. So just practice this, and it's honestly gonna, it's literally the same thing for bearish. It's the same thing. We come up, this high did not create a new low, so it's a failure swing. We're gonna take it as liquidity to target. And what are we doing? Internal liquidity to external liquidity, taking out this high and then finding a POI somewhere up here. But this is still internal liquidity on a higher time frame. Take that out, hit a POI, and then where are we targeting now? External liquidity, this low on a higher time frame. That will be our external liquidity. It's literally back and forth. Buy stops to sell stops. Sell stops to buy stops. Okay? A drop in a bullish market is a hunt for sell stops. A bounce in a bearish market is a hunt for buy stops. Okay, so just remember that. Those are key. Those are 100% key. So I hope this was clear with identifying ranges. If you still are having trouble with identifying this, let me know and we can go over it. But understand that a weak high will always clear liquidity and break structure. I mean, a strong high. A strong high will always clear liquidity and break structure. That would be a strong high. A low or a high that does not break structure. It can clear liquidity, but if it does not break structure, it's weak. Okay, remember that. It is weak. So, like I said, I hope you guys understand this. Hopefully it was easy to understand. You may need to watch this over and over. And I encourage you to watch this over and over. And also look at this on the charts in live market. And you don't need to mark anything up. Just stare at the charts. And I promise you, you'll see price ping-ponging back and forth. You'll see buy stops taken out. You'll see liquidity taken out one end. And then liquidity will be taken out on the other end. So just watch this video over and over again. If you guys still have any questions, let me know.